The collapse of the Terra Luna stablecoin ecosystem resulted in massive losses. But despite this, more computational stablecoin initiatives are being started, and some of them have already broken the buck by losing their peg. The fact that the top stablecoin Tether's reserve-backed USDT lost its peg for several months following the collapse of Terra Luna only serves to compound this. In this video, we'll be looking at the collapse of the stablecoin, what triggered it, and what the future holds for the stablecoin. Hello, and welcome back to Crypto World. Stablecoins are a type of cryptocurrency that is linked to a reserve asset. For example, a currency that likes of the dollar or euro, or a commodity such as gold, oil, or real estate, to reduce the validity of their value. In contrast to Pax Gold, which is based on gold pieces, Tether USDT is anchored to the US dollar. This contrasts with other cryptocurrencies like Bitcoin, which have no external support. Stablecoins also come in varieties. First, there are stablecoins backed by currency, such as USD Coin or USDC, wherein there is a $1 bank deposit for every $1 in USDC. Then some stablecoins are supported and collateralized by cryptocurrencies, while stablecoins like DAI and MIM are available for interest-bearing crypto assets. Last but not least, there are under-collateralized algorithmic stablecoins like UST, the majority of which are predicted on trading opportunities where the currency is off the $1 peg. Stablecoins are used by investors as a hedge against the erratic price changes that can occur with other cryptocurrencies. They are also used on DeFi platforms to lend cryptocurrencies, because it's unlikely that the value of the security or currency-backed token will alter between the time a purchaser is authorized for a loan and the time the cryptocurrency is delivered to the person's digital wallet. Additionally, traders use stablecoins as opposed to turning more highly unstable assets into hard currency, which can be costly and subject to tax significance. Now that we have a proper understanding of stablecoins and how they operate, let's look at the recent trends and the trajectories. USDN, the neutrino algorithmic stablecoin, saw its second significant loss of peg on Friday, August 26, 2022, falling momentarily to 91 cents and then dipping to 96 cents. According to CoinDesk, liquidity issues have caused it to be at least somewhat below the peg since August 6th. Sasha Ivanov, the creator of USDN, told the cryptocurrency news source that they have to improve the algorithm. For a digital commodity that claims to have a steady rate, this poses a bit of an issue. Also, the algorithmic decentralized stablecoin on the Tron network, USDD, continues to look for a stable US dollar peg. According to data provider CoinGecko, the USDD stablecoin, promoted by Justin Sun, the founder of Tron, and controlled by Tron's decentralized autonomous organization, dropped to a little under 97 cents early on Monday, reaching its lowest level since June 2022. It fell below the 3% price fluctuation cutoff set by the decentralized autonomous organization for price changes to qualify as DPEGs. Last month, USDD diverged from the presumptive 1-to-1 rate of exchange with the US dollar, as investor sentiment in digital assets was weakened by the failure of FTX, formerly the third largest cryptocurrency exchange in the world. Following the FTX disaster, some of the most popular stablecoins shook, including Tether USDT, but they soon regained their peg. The gradual rise in the stablecoin's domination rate in the USDD 3CVR liquidity pool centered on the decentralized exchange curve palettes that project DPEG from USDD. At the time of this video, USDD represents 86% of the pool's $34.5 million in total liquidity, up from 80% on November 10, 2022. The significant imbalance shows that users are exchanging USDD more frequently than DAI or USDC and USDT for the other parts of the pool. Justin Sun tweeted that he is deploying more capital to support USDD and emphasized that the algorithmic stablecoin has a 200% collateral ratio to calm the market. Crypto Twitter is speculating that the dollar-pegged coin UST, which was based on Terra's now existing algorithmic stablecoin USDD, will also lose its peg as a result of USDD's failure to do so. UST's May meltdown destroyed billions of dollars in investor value. However, UST's market capitalization before the crash was a whopping $18 billion, which is 18 times greater than the company's going market rate of less than $1 billion. The question on a lot of lips now is what is triggering the collapse? Before we continue with the rest of the video, check out and watch the other videos on the channel, like and comment on this one, and subscribe to never miss a video. Well, in May 2022, just after the United States Federal Reserve increased interest charges by 0.5%, stablecoins were hit by a more serious crypto sell-off. A lot of investors moved away from riskier assets such as stablecoins and other cryptocurrencies as a result of rising inflation and economic unpredictability. Then the USDT pegging and the crash of Luna brought down larger crypto markets. Terra has a blockchain of its own, just like Bitcoin or Ethereum. Its main offering is the UST, an algorithmic stablecoin tied to the dollar that depends on code, ongoing market activity, and public perception to keep its peg. The computational connection between UST and Terra's foundation currency, Luna, also served to theoretically support the peg. Algorithmic stablecoins operate via an arbitrage-encouraging mechanism. It is essentially game theory. People can purchase 1 UST, for instance, at 98 cents and receive $1 worth of Luna, making a 2% profit. They can exchange $1 in Luna for $1 in UST and make a profit of 2 cents if 1 UST is up to $1.02. The worth of UST derived from a lending site called Anchor, which gave buyers of UST who lent it to the program a 19.5% stake. In addition, Terra had other defenses in place to protect its peg, such as a backup of billions of dollars worth of Bitcoin. What then transpired? A downward spiral. That's what happened. Some experts contend that wealthy investors short-sold the Terra stablecoin to attack it. They borrowed a sizable amount of Bitcoin to purchase UST to generate big returns when the price of UST dropped after selling all of their Bitcoin to the market to spread panic. As a result, UST depegged from the dollar, which led to a bank run as investors who'd already received interest through Anchor rushed to sell their holdings before the connected token Luna also fell. Additionally, according to data, in the 2 weeks following FTX's collapse, investors redeemed about $3.5 billion worth of stablecoins, including $2 billion in USDT. The market valuation of the stablecoin economy as a whole decreased by $28 billion in 2022. However, getting rid of stablecoins might not be the best long-term decision because there are benefits to cryptocurrencies with price stability. Stablecoins are in theory digital currencies that are designed to track the value of significant hard currencies like the US dollar, the euro, and the British pound. They are designed to perform similarly to ordinary coins while avoiding the regular price fluctuations that are linked with such. The name stablecoin makes its purpose quite apparent. This class of asset asserts to offer stability in the highly erratic world of cryptocurrencies, where prices frequently change abruptly. Furthermore, respectable stablecoins that are purportedly directed back to fiat or cryptocurrency reserves appear to be serving their intended function as well. Stablecoins do in fact lower financial system risks, according to U.S. Securities and Exchange Commission's chair Gary Gensler, who also argued that they should be subject to the same regulatory framework as money market funds. Stablecoins maintain all the advantages of blockchain technology, making them preferable to fiat money. The ability to use them in cryptocurrency apps by lenders, borrowers, yield farmers, and for other activities is just one of these. Others include instantaneous and low-cost transactions, increased transparency, and increased traceability. So, what is the future of stablecoins? Please note that this video is purely for educational purposes and its content is not to be taken for financial or investment advice. According to experts, stablecoins are essential to the cryptocurrency market because they combine low volatility with the advantages of blockchain technology. Stable virtual currencies are gaining ground on traditional cryptocurrencies despite recent sell-offs. Recently, stable digital assets reached a new all-time high in the share of the market at 18% before falling to 16%, but they are still above their 11% portion of the overall cryptocurrency industry from a year ago. Several jurisdictions may finish developing their stablecoin institutional arrangements by the end of 2023, given the benefits of control in this area. Crypto business will receive a much-needed boost for flexible designs and unambiguous rules, which might help lessen the effects of the current winter and possibly prepare the market for the next bull run. The aforementioned legislative improvements may also contribute to the stabilization of local economies and increase the chances for conventional finance and major tech businesses to enter the market and launch their stablecoins. Citizens might also have access to a more secure and practical approach to protect themselves from a weak macroeconomic environment and volatile world currencies. Thanks for watching. If you have any thoughts on this video, drop them in the comment section. Also, if you want to learn more about cryptocurrencies and stay up to date on the latest news in the crypto space, turn on the notifications button so you're notified whenever we upload new videos like this.